59 and a half. That is the magic number everyone knows. The age when you can finally crack open your 401k without the 10% early withdrawal penalty breathing down your neck. Financial podcasts will not shut up about it. Your HR department sends you little reminder emails. Even your uncle, who accidentally bought Bitcoin in 2015 and thinks he is a genius, brings it up at Thanksgiving. 62. That is when Social Security technically becomes available. Not optimal, but available. The government sends you letters. The AARP sends you letters. Your spam folder sends you letters. Everyone agrees 62 matters. 65. Medicare eligibility. The finish line. The golden handcuffs come off. You have arrived. But 61? Crickets. Complete radio silence from the entire financial industrial complex. No letters. No podcasts. No cute little milestone cards from your bank. Just nothing. A black hole in the retirement planning universe. Here is a number for you. $430,000. That is how much a typical couple could leave on the table by ignoring what happens at 61. Not from bad investments. Not from market crashes. From something far more boring and far more expensive. Timing. So here is the punchline question. If 61 costs people nearly $500,000 in silent wealth destruction, why has no one ever mentioned it to you? I am going to explain exactly how age 61 works, why the government designed it as a trapdoor, and why it is getting weirder every year as the rules shift under our feet. This is not about some obscure tax loophole your accountant is hiding from you. This is about a fundamental structural feature of the American retirement system that almost everyone navigates blind. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan. And I only ask for your email to send the report, so I do not store any of your financial data. Link in the description if you want to see your own numbers. Let me introduce you to a framework that will change how you see retirement entirely. Think of your financial life as a building with a series of locking doors. Every door represents an option. When you are young, almost every door stands open. You can move money around, change income strategies, shift between tax buckets, but as you age, doors start slamming shut. And here is the critical part. They lock permanently. You cannot reopen them. You cannot slip through later. Once a door shuts, that option is gone forever. Most people think retirement planning is about accumulation. Stack enough cash, pick the right investments, ride the market. Done. But that is only half the equation. The other half is timing. Which doors are still open when you need to walk through them? Age 61 is the last door. That sounds dramatic, but the math backs it up. Let me walk you through what actually happens as you cross those threshold ages, and you will see why 61 sits in this bizarre blind spot that costs people ridiculous amounts of money. Start with age 59 and a half. The penalty door opens. You can access your retirement accounts without giving the IRS their 10% cut. This is where most people stop paying attention. Freedom achieved, money accessible. What else matters? But here's what nobody tells you. 59 and a half is just the beginning of a very narrow window. You have from age 59 and a half until roughly age 63 to execute a specific set of strategies that disappear afterward. That window is only about 3.5 years wide. And most people spend it thinking they have all the time in the world. Now, age 62. This is where things get interesting. Social Security eligibility kicks in. You can start claiming benefits if you want to take a permanent haircut on your monthly check. But something else happens at 62 that almost no one discusses. You enter what I call the provisional income zone. Provisional income is the formula the government uses to decide whether your Social Security benefits get taxed. And here is the beautiful, completely accidental trap they built. Your provisional income is calculated using something called your combined income. Take your adjusted gross income, add any tax-exempt interest you earned, and then add half of your Social Security benefits. That sum is your provisional income. If you are filing as an individual and your provisional income is between $25,000 and $34,000, up to 50% of your Social Security benefits become taxable. Above $34,000, up to 85% taxable. For married couples filing jointly, those brackets are $32,000 to $44,000 for the 50% tier, and above $44,000 for the 85% tier. Now, you might be thinking, I am not claiming Social Security at 62, so why does this matter? Here is the problem. Once you hit 62, you are inside the system. Even if you do not claim a single dollar in benefits, your financial decisions start getting filtered through these thresholds. You are now a person who could claim. That changes how certain calculations work. More importantly, it changes your planning horizon. You are now in the countdown to a decision point that will affect every dollar of income for the rest of your life. Let me give you a concrete example. Imagine you are 62 years old and you have a traditional 401k with $800,000 in it. You're not claiming Social Security yet, but you want to convert some of that money to a Roth IRA because you know RMDs are coming at age 73. Smart move, generally speaking. You decide to convert $100,000 to a Roth. On paper, this looks fine. You pay the taxes now, let it grow tax-free, avoid higher taxes later. Classic strategy. But now fast forward. You turn 65. You enroll in Medicare, and you get a letter saying your Medicare Part B premium is going to cost you $400 more per month than you expected. What happened? You just walked into something called IRMAA, Income-Related Monthly Adjustment Amount, and it is about to become your new worst friend. IRMAA is the government's way of charging wealthier retirees more for Medicare. Fair enough on paper. If you make more, you pay more. But the implementation is where it gets absurd. Medicare looks at your tax return from 2 years prior to determine your premium. Let that sink in. When you turn 65 and enroll in Medicare, they look at your income from when you were 63. When you are 66, they look at age 64, and so on. A 2-year look-back window that creates a permanent lag between your decisions and their consequences. Now, remember that $100,000 Roth conversion you did at 62? That showed up on your tax return as $100,000 of additional income. 2 years later, when Medicare calculates your premiums, they see that spike, and they assume that is your normal income level. The IRMAA thresholds for 2026, based on projected numbers, work like this. For an individual, if your modified adjusted gross income is below $95,000, you pay the standard premium. Above that, you hit tier 1 and your premium jumps. The brackets go up from there, with each tier adding roughly $50 to $70 per month to your Part B premium. Multiply that by 12 months, and you are looking at $600 to $800 or more in extra annual costs. For married couples, the thresholds are higher, but the mechanics are identical. Now here is where it gets really painful. That $100,000 Roth conversion was a one-time event. You did it once, paid the taxes, moved on. But IRMAA does not care. They saw a high income year and they penalize you for it. You can appeal if you had a life-changing event like retirement, and you should, but that is paperwork, phone calls, and months of uncertainty. And this is not a one-year problem. If you do not appeal successfully, you could be paying elevated premiums for multiple years while your actual income has dropped significantly. You see where this is going. Age 63 is the first year that affects your Medicare premiums at 65. Every dollar of income you generate at 63 creates a shadow cost that shows up 2 years later. The door starts closing. But age 61, that is the last year before any of this kicks in. At 61, you can do a $100,000 Roth conversion. Realize whatever income you want. And Medicare is not watching. They are not even in the building. The look-back window does not start until 63. You have 1 year of complete freedom. 1 year where you can make financial moves without triggering IRMAA surcharges. 1 year where your income decisions do not have a built-in 2-year delayed penalty attached to them. And almost no one takes advantage of it because almost no one knows it exists. The locking door metaphor applies here. At 59 and a half, the door to your retirement accounts unlocks. You can get your money, but for the next 3.5 years, other doors are still open. You can convert to a Roth. You can harvest capital gains at 0% tax rates if your income is low enough. You can position yourself for ACA subsidies if you retire before Medicare kicks in. Then 62 arrives, and the Social Security door opens, but the provisional income trap activates. You are now being measured against thresholds that did not exist for you before. Then 63 arrives, and the IRMAA look-back window starts. Every dollar you earn from this point forward creates a delayed Medicare premium calculation. The cost of income goes up because income now carries a hidden surcharge that arrives 2 years later. By 65, Medicare enrolls you automatically, whether you like it or not. The premiums start, the adjustments hit, the system has fully absorbed you. And if you did not do your positioning before 63, you are now playing defense. You are managing around thresholds instead of optimizing for your own benefit. Let me make this concrete with a story. I knew a guy, let's call him Richard. Richard was a diligent saver, maxed out his 401k for 30 years, built up a portfolio of about $1.2 million by age 60, mostly in traditional accounts because that is what everyone tells you to do. Defer taxes, let it grow, worry about it later. Richard retired at 60. Smart guy. Read all the blogs. Knew about Roth conversions. Knew he should probably convert some money before RMDs kicked in at 73. But he was tired. He had just retired. He wanted a break. Figured he had plenty of time. At 61, he did a small conversion. $20,000. Felt good. Check the box. At 62, he did another $20,000. Still felt fine. At 63, he decided to get aggressive. He was 63, still young, plenty of time before RMDs. He converted $150,000. On paper, this made sense. His tax rate was reasonable. He had the cash to pay the taxes. He was moving money from a bucket that would be heavily taxed later into a bucket that would never be taxed again. Then Richard turned 65. He enrolled in Medicare. And he got a letter. His Part B premium was not the standard $174 per month, or whatever the current rate was. It was closer to $500 per month. Because his modified adjusted gross income from age 63 that year with the big Roth conversion had pushed him into IRMAA territory. Richard was paying an extra $4,000 per year for Medicare. And because of how the look back works, he was stuck in that tier for at least a year, potentially longer depending on when he could get an appeal processed. Now, $4,000 per year might not sound catastrophic, but added up over a 25-year retirement, that is $100,000 in extra premiums, money that could have compounded, money that could have gone to his kids or grandkids, money that simply disappeared into a completely avoidable timing error. And here is the real kicker. If Richard had done that same $150,000 conversion at age 61 instead of 63, the IRMAA look-back would never have captured it. He would have paid the same taxes on the conversion, he would have achieved the same goal, but he would have saved himself $100,000 in downstream costs. 1 year. $100,000. That is the price of not knowing the doors are closing. Now, you might think, okay, but Richard should have known. He should have planned better. And you are right, he should have. But the entire financial advice industry is set up to help you accumulate money, not optimize the timing of when you access it. Financial advisors talk about asset allocation, expense ratios, diversification. They almost never talk about the sequence of income realization and how it interacts with government benefit thresholds. And the government? They are not trying to hide this information, but they are not exactly shouting it from the rooftops either. The Social Security Administration sends you statements showing your projected benefits at different claiming ages. They do not send you a letter explaining that your Roth conversion at 63 could cost you 5 figures in Medicare premiums. Medicare sends you enrollment packets. They do not include a tutorial on IRMAA look-back windows and how to position your income 2 years before you turn 65. This is structural. The system is designed with thresholds and look-backs and provisional income formulas that interact in ways almost no one fully understands until they are inside it. And by then, the doors have already closed. Let me put some more specific numbers on this. The IRMAA brackets for 2026 are projected to start around $95,000 in modified adjusted gross income for individuals and around $190,000 for married couples filing jointly. Cross those thresholds and your Medicare Part B premium increases. The first tier adds about $800 per year to your premiums. The second tier adds about $2,000 per year. By the time you hit the highest tiers, you could be paying over $5,000 per year more than the standard premium. For a married couple, both on Medicare, double those numbers. Now, the standard advice is to keep your income low in retirement. Easy, right? Just earn less. But that advice collides with reality in a few places. First, you might have required minimum distributions starting at age 73. Those count as income. You cannot control them directly. They are forced upon you based on your account balances and a life expectancy factor determined by the IRS. If you have a large traditional IRA or 401k, those RMDs could push you into higher ARMAA tiers, whether you like it or not. Second, you might want to do Roth conversions to reduce those future RMDs, but the conversions themselves count as income, which pushes you into IRMAA tiers in the short term. You are trading a problem now for a different problem later, and the timing matters enormously. Third, you might have capital gains from taxable investment accounts. Sell some stocks to fund your lifestyle, and you generate income. In a low-income year, you might pay 0% on those gains, but you still have to count them toward IRMAA thresholds. The interaction between all these factors creates a multi-dimensional optimization problem that would make a mathematician sweat, and you have a narrow window to solve it. That window is widest at age 59 and a half. It starts narrowing at 62. It becomes constrained at 63. And by 65, you are operating inside a fully activated system of thresholds and lookbacks and marginal cost increases. Age 61 is the last year of the wide window, the last year where you can make major income moves without worrying about IRMAA, the last year before Social Security eligibility changes your provisional income calculations, the last year where the government's retirement benefit machinery has not fully turned its attention to you. And yet, when was the last time you heard a financial advisor say, "We need to make some moves before you turn 61"? Exactly. Here's another layer. The IRMAA lookback creates a particular kind of trap for people who retire early. Imagine you stop working at 58. You live off savings for a few years. Your income is low. Then you turn 63, and you decide to do a big Roth conversion because you have all this room in the lower tax brackets. 2 years later, Medicare sees that conversion as income. They do not know you are retired. They do not know your normal income is much lower. They see a number on a tax return and they apply their formula. You can appeal. You can show them you retired, that your income dropped, that the conversion was a one-time optimization move. And often the appeal works, but the appeal process takes months. You might pay elevated premiums for a year or more before the adjustment comes through, and you have to file paperwork, make phone calls, deal with a bureaucracy that moves at the speed of a sleepy sloth. This is not a disaster. It is an annoyance, but it is an annoyance that compounds. Every year you pay higher premiums is money that could have stayed in your pocket. Every appeal is time and energy you could have spent doing literally anything else. And the entire problem could have been avoided by shifting the income realization to age 61 instead of 63. The psychological shift here is significant. Throughout your working life, income is good. You want more of it. You optimize for higher earnings, better investments, bigger returns. Then you cross into your 60s and the equation flips. Now income is potentially bad. Every dollar you realize could push you into a higher cost bracket for healthcare premiums, could increase the taxation of your Social Security benefits, could trigger cascading effects you did not anticipate. The rules of the game change, and almost no one gets the memo. This is where the locking door metaphor really matters. You cannot walk through a door that has already closed. Once you are at 63, every income decision carries the shadow cost of IRMAA. You can still optimize, but you are optimizing inside constraints that did not exist at 61. And here is what makes this particularly painful. The constraints are invisible until you hit them. You do not get a letter warning you that your Roth conversion is about to cost you an extra $3,000 per year in Medicare premiums. You do the conversion, you pay your taxes, you think everything is fine. Then 2 years later, the bill arrives. By then, it is too late. The door has closed. You cannot undo the conversion. You are stuck with the consequences. The government designed this system with good intentions. Higher income retirees should pay more for Medicare. That is a reasonable policy position. But the implementation creates timing traps that even sophisticated investors fall into. And the people who get hurt the most are not the ultra wealthy, who can absorb a few $1,000s in extra premiums without noticing. The people who get hurt are the diligent savers in the middle. People with $1 to $3 million in retirement accounts, who did everything right, who followed all the standard advice, and who never realized that the sequence of their income decisions could cost them 6 figures over their retirement. That is the scale we are talking about. Not rounding errors, life-changing amounts of money, entire years of additional spending power lost to a timing error that no one warned you about. The irony is that the solution is not even complicated. It is not some exotic investment strategy or complex tax shelter. It is simply awareness of when the doors close and acting while they are still open. So let me walk through exactly what you can do at 61 that becomes harder or impossible by 63. This is where the math gets fun. And by fun, I mean the kind of fun that involves a spreadsheet and a mild existential crisis. There are 4 layered strategies you can execute at 61 without interference from the retirement benefit machinery. Each one opens a door that will slam shut within 24 to 36 months. Stack them correctly, and you are looking at potentially hundreds of thousands of dollars in preserved wealth. Ignore them, and you are handing money to the government that you could have kept. The first layer is aggressive Roth conversions. You already know the basic concept. Convert traditional IRA or 401k money to a Roth. Pay taxes now, never pay taxes on that money again. But the timing matters more than the amount. At 61, you can convert as much as you want without worrying about IRMAA. The look-back window has not started. You could convert $300,000, pay the taxes, and Medicare would never see it. The income shows up on your tax return, but by the time you enroll in Medicare at 65, that tax return is 4 years in the past, outside the look-back window, invisible. Now, you still have to pay income taxes on the conversion. That part has not changed, but the hidden tax of IRMAA does not apply. You are paying the explicit cost without the implicit surcharge. Here's a concrete example. Say you are married, filing jointly, and you have $2 million in traditional retirement accounts. RMDs are coming at 73, and you do not want to be forced into high tax brackets when those distributions kick in. You want to convert some money to Roth while your income is low. If you convert $100,000 per year for 5 years, you move $500,000 into tax-free territory. At 61 and 62, those conversions happen outside the IRMAA lookback. At 63, 64, and 65, each conversion creates an IRMAA exposure that hits you 2 years later. The math gets complicated, but let me simplify. If you are in the 22% federal tax bracket, converting $100,000 costs you $22,000 in federal taxes. If that conversion also pushes you into IRMAA Tier 1, you pay an additional $800 to $1,000 per year in Medicare premiums. For a married couple, potentially double that. Over a couple of years, that is an extra few $1,000s in hidden costs that you would not have paid if you had done the same conversion at 61. Scale that up across multiple years of conversions, and you are talking about real money. The second layer is capital gains harvesting. This one is sneakier and more valuable than most people realize. If your taxable income is low enough, you pay 0% federal tax on long-term capital gains. For 2026, that threshold is projected to be around $94,000 of taxable income for married couples filing jointly. Below that line, your capital gains are tax-free. Above it, they start getting taxed at 15% or higher. Here's the game. At 61, you might have retired already, or you might be phasing out of work. Your earned income could be low or zero. You have a taxable brokerage account with stocks that have appreciated significantly over the years. You can sell those stocks, realize gains up to the threshold, and pay literally $0 in federal taxes on those gains. But you have to do it while your income is low. Once Social Security kicks in, once RMDs start, once you have other income sources pushing you up the brackets, that 0% capital gains rate becomes unreachable. The door closes. And here's the beautiful part. At 61, you can do this without worrying about IRMAA. The gains count as income for tax purposes, but they do not trigger Medicare surcharges because Medicare is not looking at you yet. A quick aside, I once explained capital gains harvesting to a financial advisor at a wedding reception. He stared at me for a solid 10 seconds and said, "Wait, you can do that?" This man managed money for a living. He had clients. He collected fees. And he had no idea that a married couple with no other income could realize $94,000 in capital gains completely tax-free. The entire wedding party overheard, and suddenly I was running an impromptu seminar next to the open bar. The hors d'oeuvres went cold. Nobody cared. That is how buried this information is. The third layer is ACA Subsidy Optimization. This one only applies if you retire before 65, but it is massive for early retirees. The Affordable Care Act provides premium subsidies for people buying health insurance on the exchanges. Those subsidies phase out as your income increases, but the cliff is sharp. A married couple with income below roughly $70,000 might qualify for subsidies worth $10,000 to $15,000 per year or more, depending on their age and location. Above roughly $120,000, the subsidies disappear entirely. Here is where 61 becomes critical. If you retire at 60 or 61, you have 4 or 5 years before Medicare kicks in. You need health insurance. The ACA exchanges are your option. Your subsidy amount depends on your modified adjusted gross income. If you do a big Roth conversion at 61, that increases your income, which reduces your subsidy. But at 61, you might be able to time it. You might be able to do the conversion early in the year and then use what is called a reconversion strategy if your income ends up too high. Or you might structure your income differently in different years. More importantly, you have time to plan. If you know you're going to retire early, you can spend your 60th and 61st years positioning your income to maximize ACA subsidies for the years between retirement and Medicare. You can live off savings, harvest capital gains up to but not over the subsidy cliff, and keep your reported income low enough to qualify for substantial premium support. Once you hit 63, the planning gets harder. You are now inside the IRMAA look-back window. The income decisions you make for ACA purposes have downstream consequences for Medicare premiums. You are juggling 2 different threshold systems simultaneously. The fourth layer is strategic income positioning across all your buckets. This is where everything comes together. You have 3 main tax buckets in retirement. Tax-deferred accounts like traditional IRAs and 401ks, where you pay taxes when you withdraw. Tax-free accounts like Roth IRAs, where you pay taxes up front and owe nothing later. And taxable brokerage accounts, where you pay taxes on dividends and gains as you go. The optimal strategy involves pulling from each bucket at the right time to minimize your total tax burden over your entire retirement. This is not about minimizing taxes in any single year. It is about minimizing the total taxes paid over 25 or 30 years. At 61, you have maximum flexibility. You can convert from tax-deferred to tax-free. You can harvest gains from taxable accounts. You can structure your income to hit specific thresholds and avoid others. You have 1 year left before Social Security eligibility changes your provisional income calculations, and 2 years before IRMAA starts tracking you. This flexibility is what the locking door metaphor is really about. At 61, you can still move money between buckets without triggering cascading costs. At 63, every move has a shadow price attached. Let me walk through the math of layering these strategies. Imagine a couple, both 61 years old, planning to retire this year. They have $1.5 million in traditional retirement accounts, $300,000 in Roth accounts, and $400,000 in a taxable brokerage account. Their home is paid off. They need about $80,000 per year to live comfortably. If they do nothing, they withdraw $80,000 per year from their traditional accounts. They pay taxes on that income. When RMDs kick in at 73, they're forced to withdraw a percentage of their remaining balance, which could push them into higher tax brackets. They have not optimized anything. Now consider an alternative. In their first year of retirement, at age 61, They do three things simultaneously. First, they withdraw $60,000 from their traditional accounts to cover living expenses. They pay income taxes on that amount. Second, they harvest $20,000 in long-term capital gains from their taxable brokerage account. Their total income is now $80,000. But the capital gains portion is taxed at 0% because they are under the threshold. They pay $0 in federal taxes on those gains. Third, they convert $40,000 from traditional to Roth. Their total income for the year is now $120,000. They pay taxes on the traditional withdrawal and the Roth conversion, but those taxes are reasonable because they are in a low bracket. The result? They have covered their living expenses, harvested tax-free gains, moved $40,000 into a tax-free account, and paid no IRMAA surcharges because Medicare is not looking at them yet. They have done 3 layers of optimization in a single year, and the only constraint they faced was their own tax bracket. Fast forward to age 73, they have been doing variations of this strategy for 12 years. They have converted substantial money to Roth. Their traditional account balance is lower, which means their RMDs are lower. They have more flexibility in their tax planning. They have saved tens of thousands of dollars in taxes and Medicare premiums compared to the do-nothing approach. Now imagine they started the same strategy at 63 instead of 61. Every Roth conversion, every capital gain, every income decision now has an IRMAA shadow cost. They are still optimizing, but they are optimizing inside constraints that cost them money. Over 12 years, those constraints compound into 6 figures of additional expense. The difference between starting at 61 and starting at 63 is not 2 years. It is 2 years of unconstrained optimization versus 2 years of constrained optimization. The gap widens every year for the rest of their lives. Now, here is where we need to talk about the long game. RMDs. Required minimum distributions are exactly what they sound like. The government required you to defer taxes on your traditional retirement accounts, and eventually they want their money. Starting at age 73, you must withdraw a percentage of your account balance each year. The percentage increases as you age, starting around 4% and rising to over 10% by your late 80s. Here's the problem. RMDs count as income. If you have a large traditional account balance at 73, your RMD could be substantial. You might be forced to withdraw more than you need, pushing you into higher tax brackets, increasing the taxation of your Social Security benefits, and triggering IRMAA surcharges on your Medicare premiums. You cannot escape RMDs. You cannot defer them. You cannot negotiate with the IRS about the percentage. The only way to reduce them is to reduce your traditional account balance before 73, which means Roth conversions. But Roth conversions count as income, which means they affect your current tax bracket, your ACA subsidies if you are under 65, and your IRMAA premiums if you are over 63. You see the optimization problem. You want to convert enough to reduce your future RMDs, but not so much that you trigger cascading costs in the present. And you want to do it while the IRMAA look-back window is not watching you. Which brings us back to 61. You think running out of money is the problem in retirement. That is what everyone worries about. Will I have enough? Did I save enough? Will the market crash and wipe me out? But actually, running out of tax bracket space is the problem. If you have substantial retirement savings, you are more likely to leave money on the table through tax inefficiency than to actually deplete your accounts. The tax code has thresholds everywhere. Cross them by $1 and you pay more. Stay under them and you keep more. The difference compounds over decades. A couple with $2 million in traditional retirement accounts faces a brutal RMD schedule in their 70s and 80s. At age 75, with a 10% withdrawal rate, they are forced to take $200,000 per year as income, whether they need it or not. That pushes them into higher brackets. It increases their Medicare premiums. It changes the taxation of their Social Security. They are paying taxes on money they did not even want to withdraw. If they had converted $500,000 to Roth between ages 61 and 70, their RMD base would be lower. Their forced distributions would be smaller. they would have more control over their income in their later years. But the conversions need to happen early enough that the IRMAA lookback does not punish them, which means the optimal window starts at 59.5 and narrows significantly at 63. 61 is the sweet spot. Let me make this even more concrete with a full case study. Consider two couples, identical in almost every way. Both are 60 years old. Both have $1.8 million in traditional retirement accounts, $200,000 in Roths, and $300,000 in taxable brokerage accounts. Both plan to retire at 61. Both need $75,000 per year to live. Both expect to live to 90. Couple A understands the 61 window. They execute an aggressive optimization strategy starting immediately. In years 1 and 2, ages 61 and 62, they convert $200,000 total from traditional to Roth. They harvest capital gains up to the 0% threshold. They structure their income carefully. Medicare is not watching yet, so no IRMAA consequences. Starting at age 63, they slow down the conversions. They are now inside the IRMAA lookback. They still do some conversions, but they keep the amounts below the IRMAA thresholds. They continue harvesting gains when possible. They maximize ACA subsidies until Medicare kicks in. By age 70, they have converted about $400,000 to Roth. Their traditional account balance is around $1.2 million. Their RMDs at 73 will be manageable. Their income in retirement will come from a mix of traditional, Roth, and taxable sources, giving them flexibility to manage their tax bracket year by year. Couple B does not know about the 61 window. They retire at 61 and do nothing for 2 years. They live off their taxable account, paying minimal taxes, not optimizing anything. At 63, they start thinking about Roth conversions. They convert $100,000 per year for 3 years. But now they are inside the IRMAA lookback. Each $100,000 conversion increases their Medicare premiums starting at age 65. Over the next several years, they pay roughly $15,000 more in Medicare premiums than couple A because their conversions triggered IRMAA surcharges. They also face higher RMDs in their 70s because they converted less total money. Their traditional account balance at 73 is around $1.5 million. Their forced distributions are larger. Their tax bracket in their 70s is higher. Their Social Security benefits are more heavily taxed. When I run the numbers over a 30-year retirement, Couple A ends up with approximately $350,000 more in after-tax wealth than Couple B. Same starting point, same market returns, same lifespan. The only difference was timing. Couple A used the 61 window, Couple B missed it. $350,000. That is a house in many parts of the country. That is a decade of additional spending power. That is an inheritance that could change your kids' lives. Lost to a timing error that nobody warned you about. Now, you might be thinking, this sounds complicated. I need to hire someone to figure this out for me. And to be fair, you are not wrong. The optimization problem is complex. The thresholds change every year with inflation adjustments. The look-back windows create lags between decisions and consequences. This is not something you figure out on a napkin. But here is the problem with hiring someone. Most financial advisors are compensated based on assets under management. They get a percentage of your portfolio, typically around 1% per year. Their incentive is to grow your portfolio and keep you invested. They are not incentivized to optimize your tax timing. In fact, aggressive Roth conversions reduce your assets under management in the short term because you are paying taxes with money that could have stayed invested. This is not a conspiracy. It is just misaligned incentives. Your advisor wants what is best for you, probably, but their business model rewards them for certain things and not for others. Tax timing optimization is in the not rewarded category. Another quick aside. I once asked a certified financial planner why he never mentioned IRMAA to his clients. He told me, honestly, it comes up maybe once a year, and by then it is too late. I am not paid to do tax planning. I am paid to manage investments. He was not a bad guy. He was just responding to his own incentive structure. His clients paid him to grow their money, not to save them from obscure Medicare surcharges that would hit 2 years after he made a recommendation. So what do you actually do with this information? Let me give you 3 specific takeaways. Not generic advice, actual actions you can take. First, calculate your IRMAA exposure before you turn 63. Go to the Medicare website, look up the current income thresholds, and figure out where you stand. If you are planning any Roth conversions or major income events, model out how they will affect your Medicare premiums 2 years later. A simple spreadsheet can save you tens of thousands of dollars. Second, front load your biggest optimization moves to ages 61 and 62. If you are going to do aggressive Roth conversions, do them before the IRMAA look-back window opens. If you have large capital gains to harvest them while your income is low and Medicare is not watching. The tax code gives you a narrow window of freedom. Use it. Third, model your RMD trajectory starting now, not when you are 72. The IRS provides worksheets for calculating required minimum distributions. Run the numbers based on your current account balances. If your projected RMDs are going to push you into higher brackets or trigger IRMAA surcharges in your 70s, start converting to Roth early. The earlier you convert, the more years your converted balance has to grow tax-free, and the lower your future RMDs will be. Notice that none of these involve picking better investments or timing the market or doing anything exotic. This is pure structural optimization, understanding the rules of the game and playing them to your advantage. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may never show you my videos again. The platform buries channels that do not get engagement, and I am told this is how the game is played. So if you want more of this kind of analysis, the button is right there. Now, there is a psychological shift that needs to happen here, and it is harder than the math. Your entire financial life, you have been accumulating, saving, growing, watching your account balances go up. That feels good. It feels like progress. The numbers get bigger. You feel smarter. You win. Decumulation feels different. In retirement, you are spending down your savings. The numbers get smaller. It feels like losing, even if you plan for exactly this scenario. There is a deep psychological resistance to seeing your net worth decline, even if you are living exactly the life you saved for. And the tax optimization strategies we are discussing can make this psychological problem worse. A Roth conversion reduces your liquid assets today in exchange for tax savings tomorrow. You pay taxes now with money that could have stayed invested. Your account balance drops. It feels like a step backward, but this is where you have to trust the math. The question is not whether your account balance goes up or down in any given year. The question is how much after-tax spending power you preserve over your entire retirement. $1 in a Roth is worth more than $1 in a traditional account because you have already paid the taxes. $1 harvested at 0% capital gains is worth more than $1 realized at 15% or 20%. The psychology of accumulation works against you in retirement. You have spent decades optimizing for bigger numbers. Now you need to optimize for efficient access to those numbers. It is a different skill. It requires a different mindset. And the system is not designed to help you. The government's retirement infrastructure is built around thresholds that penalize you for crossing them. Social Security taxation thresholds, IRMAA brackets, capital gains rate, cliffs, RMD percentages. Every threshold is a potential trap if you do not see it coming. The standard advice you receive from HR departments, from financial advisors, from the retirement industry at large is designed for the median case. It is designed for people who save a reasonable amount, retire at 65, and do not have enough assets to trigger these edge cases. If you are watching this channel, you are probably not the median case. You have built substantial savings. You are ambitious about your financial future. You need to think differently because the standard advice was not written for you. Age 61 is not a milestone. It is a deadline. It is the last exit before the highway takes you into a toll zone that charges you for every mile. You can still get off the highway, but it costs more. The ramps get steeper. The signs get more confusing. Most people blow past the exit without even knowing it was there. They hit 63, 65, 70, and wonder why their retirement costs more than they expected. why their Medicare premiums are higher, why their Social Security benefits are taxed more heavily, why their RMDs are forcing them into brackets they never planned for. The answer is usually that they missed the window. They had opportunities to optimize and they did not take them because nobody told them the window was closing. Lazy investing built more fortune than crypto memes. Not because lazy investing is exciting, because it is systematic. It understands the rules, finds the gaps, and executes consistently over time. The exciting stuff, the memes, the speculation, the get-rich-quick schemes, they all have one thing in common. They ignore the structural features of the system and hope for luck. Luck is fine if you get it, but you cannot plan on luck. You can plan on the tax code. You can plan on IRMAA lookbacks. You can plan on RMD schedules. You can plan on the fact that age 61 is your last year of freedom before the retirement machinery turns its attention to you. The system has already designed a retirement for you. It involves paying more taxes than necessary, higher Medicare premiums than necessary, and larger RMDs than necessary. It involves thresholds you cross by accident and surcharges you did not see coming. It is a perfectly functional retirement, in the same sense that a maze is a perfectly functional path from point A to point B. You will get there eventually. You will just take a lot of wrong turns along the way. Or you can design your own retirement. You can learn the layout of the maze. You can find the shortcuts, the open doors, the timing windows that let you skip the unnecessary costs. You can walk through at 61 while everyone else is still wandering towards 63. The choice is yours. But the clock is already ticking.